Hello, everyone. Thank you for being on time today. We are going to get started in just a few seconds. We're just going to let everyone hop into the room. So we'll get started. Perfect. Okay. So a few things before we get into it. First of all, hello. I hope everybody is staying cool on this very, very hot and humid week. Thank you for making the choice to invest in yourself and your practice by joining today's financial planning session. Today's all about learning easy to execute strategies to help you provide better tax planning advice and improve your client's tax efficiency. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Steve Arnott, SNAP's financial planning project lead, who will provide today's demonstration and run the Q&A.
Hi, everyone.
I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab. Any messages sent that way are public to everyone. For private messaging, please use the Q&A tab.
Perfect. Thanks, Hanson, Greg, Monica, Daisy. Lots of messages, so sounds like it's good to go.
Fantastic. Thank you, everyone. So Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation, and we will get started. Some of you here today are already using SNAP projections for your financial planning needs. But for those of you who aren't already familiar with SNAP, SNAP is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you'd like to hear from other advisors who are already using SNAP, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a SNAP projection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with SNAP to grow their assets under management and increase quality referrals. And we are thrilled to share that SNAP Projections financial planning software is now fully available in French. We are also now providing customer support and product demonstrations with a French language team member. As we move into the case study, we're going to be building out multiple scenarios that we can compare and optimize. When it comes to focusing on tax efficiencies, we're going to be exploring some key areas for our case study couple who are planning to retire in just 5 years. They're wondering if they're on track for retirement and if there are any changes they can make now to improve the tax efficiency of their financial picture. So, what you're going to see here in just a few minutes when I hand this over to Steve is how we can quickly build multiple plans, compare them, and then ultimately use this functionality to highlight the net difference between where we started and where we're going. This is how you, as the advisor, can not only improve your client's outcome, but easily demonstrate the value of working together. This is a highly flexible module that allows you to pick which metrics you wish to compare and highlight. It allows you to change the timeline of your comparisons, and you can visually compare metrics with additional charts. In this case, two of the key areas we want to compare as we build multiple scenarios will be the lifetime taxes payable as well as the total estate taxes payable. Before we get into the case study, I want to make something clear. This is a more advanced webinar than what we typically try to squeeze into 1 hour. We're covering this content today because tax planning has been one of the main votes when I've asked you all on previous sessions what you'd like to learn about next time. Our first tax planning session was held in March. Many of you may have been there, and this is a refresher on this very, very important tax planning content. So, with SNAP, we can be quick and simple, or we can conduct comprehensive planning. You can sit down with a client or a prospect, enter a few data points, and create basic projections that are highly valuable within 5 minutes. We have plenty of previously recorded sessions on our YouTube page for anyone who would like to see something more basic after this. Just let me know. Today, we're going to show you that in addition to the simple plans, Snap can still model more advanced discussions while remaining easy to use and easy to understand for both the advisor and the client. So let's get into it. We will be building 3 scenarios this hour. We're going to start with the as-is base plan, and we will work to optimize first with default strategies from the software, and then we will get into some more advanced planning strategies in our third scenario. We will then be able to compare the scenarios, plus create a one-page financial plan summary report our clients will truly understand. So we'll get Steve to take over and log into Snap.
Terrific. Thanks so much, Alex. And thanks again, everyone, for joining us today. Snap Projections is a web-based platform, which means that you can access your account from any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you'll click Login to enter your username, password, and the option for a multi-factor authentication. I've entered that during today's session, so I'll click Login and go directly into the software. I'm taken initially to my clients page where I can either access any of the previous projections that I've created, or I can get started on a new client file by clicking Add New Client. As Alex mentioned, we're going to be creating 3 scenarios today for our couple. So we are creating plans for Hannah and Ruben Sharp. So I'll enter in their information here. They were born in 1970 and they're 55 years old currently and looking to retire in 5 years' time at age 60. Once we enter in our client data, you'll see in the top left corner of the software that there are 3 main sections to the tool. The first is the scenario setup, which we'll proceed through shortly, which involves entering things like the plan data, the general plan assumptions, expenses, incomes, and assets. Once we're done with the scenario setup, we will then proceed to the planning pages where all of that information comes together to show us Hannah and Ruben's life on one page. From here, we can review information, make changes as needed, and then once we're comfortable with all of the numbers, we can proceed to the client report where we can customize the charts, tables, and commentary to include in a final client-facing document. For now, we'll continue on with the scenario setup. I'll click Next at the bottom, and we'll go to the General Plan Settings page. We'll start the projection this year in 2025 with a target retirement age of 60 for both Hannah and Ruben, and we'll run the projection until each of their age 100. We have pre-populated the FP Canada guideline assumptions into the software for inflation rate and rates of return. And then I have customized the rates of return to reduce the gross return assumptions by management fees in order to arrive at an expected net return assumption. And then I've saved that as my default in the software so that all new plans start with my existing desired assumptions. And you can do that throughout the software. Clicking Next, we'll go to the expenses page, and there's a lot of flexibility with entering expenses in Snap. If you don't have a budget from your client and you don't know what they're currently spending, you can leave this page blank and Snap will help you to calculate what their spending is based off of all of the other inputs into the plan. We can also have SNAP help us calculate a sustainable level of spending that would avoid any shortfalls throughout their lifetime. If we do have information about their budget or their target spending goal, we can enter that in here, and SNAP will help us to determine whether they're on track for that level of spending. So we're going to enter in a retirement spending need of $108,000 per year. This is net of tax and inflation adjusted, and we can customize the start age for this spending need from the planning page. We can also enter in other expenses. So in this case, they want some additional travel budget of $15,000 per year. And we'll index that at the general inflation rate. We'll start at age 60 when they retire and run that until age 74. We'll click to highlight that in the reports so that the charts will have a dedicated legend item for that expense so that we can draw attention to the goal being achieved through the plan. They're also looking to do a fairly large renovation for $100,000 shortly after retiring. We're not going to index that assumption. We're just going to assume that they need $100,000 in the future year, and that's going to occur when they turn 61. So we've set up their base consistent spending need, their one-off or temporary expenses, and now we can go to the incomes page to enter in their existing sources of cash flow. So we have employment income for Hannah of $130,000. We are going to link that to the general inflation rate so that it will index with cost of living over time. We have employment income as the type so that SNAP will automatically deduct CPP and EI. It will tax the income appropriately, track RSP eligibility, and then run that income until the year prior to her retirement. And within SNAP, there's lots of flexibility to keep things quick and simple, like we have here, or you can go in and customize the exact date that the income is assumed to end if they're going to work a part year or any other sort of one-off transaction. We can add other incomes. So if the clients had a rental property, we could add that here, or if they're expecting an inheritance in a future year, we can input those cash flows accordingly. And then we can also enter in defined benefit pension plans. So Hannah has a defined benefit pension plan that will start when she retires at age 60. And that will be for $45,000 per year with a 60% survivor benefit and a 1% indexing. And then once she turns 65, the bridge benefit will fall off and it will decrease to $38,000 a year with the continued indexation. In the top left, you'll see that we can toggle between our two clients. So right now I'm on Hannah's income page. I'll click Ruben and update his employment income. So he's earning $120,000, and that will similarly run until the year prior to his retirement. I'll click next and we can go to the assets page where we'll enter in all of their existing account information. You'll see that SNAP enters in a default non-registered account as a placeholder. This shows you how you can input new account information. It also serves as a place where SNAP can allocate future surpluses if they have, say, the sale of a home in a future year or some other source of surplus. In this case, I'm going to delete the default and I'm going to just enter in their existing non-reg TFSA and RSPs. So they have a joint savings account with $300,000 currently, and that's 100% in cash. They also have a non-reg with $230,000, and that has a cost base of $70,000. So she's been holding on to that portfolio for quite a while, and that's invested in 30% fixed income and 70% equity. And you'll see SNAP pre-populates the rate of return assumption for each of these accounts based off of our general plan settings. And then I can customize those returns on an account by account basis if needed. So if I have a GIC or a particular type of investment in one specific account, I can change the rate of return assumption on a one-off basis. And then based on our asset allocation, SNAP will arrive at a total portfolio return. Hannah also has a tax-free savings account with $130,000. And she has an RSP with $380,000. Now that we've entered in her accounts, you'll see across the top of the table, there are account types for each of the registered account categories. And I can click on those tabs in order to go in and customize additional information related to those accounts. So this again is an example where you can get started creating a quick and simple plan in Snap using conservative base assumptions, which would just be that they have no carry forward room at the start of the plan. Or you can come into these additional settings pages and customize the information to really tailor the plan to your client's unique circumstances. So I'll leave the TFSA room as it is. I'll go to the RRIF tab, and I'm going to enter in her current contribution room assumption, which is 35,000. I'll go back to assets, and then I'll scroll down to the real assets section where I can input their home. So they have a home worth 1.2 million, cost of 700,000. We'll set the appreciation rate to the general inflation in the plan, and then we'll set that as joint. Now we have the ability to model multiple real assets. So if they had a cottage or a rental property, we can enter those as well, and we can indicate if they're capital gains tax applicable to the sale, and we can model the future purchase age or sale age. So if a client's saving up for a property, or if they're looking to downsize in retirement, we can model all of those transactions throughout the plan. Now that I'm done with Hannah's assets page, I'll click Ruben's name and switch over to his side. I'll delete the default. We've got the joint savings pre-populated on his page, and we also have the home because both of those were entered as joint, so we can see them from either individual's page. In addition to the joint savings, Ruben also has a tax-free savings account with 125,000, and that's invested as 40% fixed income, 60% equity. He has an RSP through his work, which has a total of 280,000. That's invested as 50% fixed income, 50% equity. And then he has an RSP personal with a total of 520,000. Similar to Hannah, I'm going to go through each of the registered tabs. So we'll leave his TFSA contribution room just with the single year available. RSP, we'll update that to 50,000 of total room. And then we have an employer matching tab where we can automatically contribute into his work RSP. So I'm going to link that to his employment income. And he's currently contributing 5% of his salary, and his employer is matching that with 5%. So now we've set up his work RSP with automatic employer matching contributions. And we can go back and then continue to the next page. So we'll go to the debts page and enter in their remaining mortgage, which has a balance of 120,000, interest rate of 5%, monthly payments of $1,800. And that's joint. And then we'll link that to the home so that if we sell the home at any time in the plan, it will repay any outstanding mortgage balance if it hasn't already been repaid. Again, we can enter in multiple debts and we can indicate if it's tax deductible. So if there's a rental property with a mortgage or there's an investment loan, we can enter that and have the tax deduction automatically factored into the plan. I'll click next and go to the government benefits page. From here, I can customize the start age and the annual benefit that the client will receive from both CPP and OAS. So I'm going to, in our default scenario, start with age 65. You'll see that because SNAP does not currently have the client's historical contribution information, we can't calculate their exact CPP value. And so we default to the national average, which is about 57% of the maximum. You can come in here and either enter in a dollar value if they're already receiving CPP or if they have a Service Canada statement, or you can estimate the percentage of maximum based off of their employment history. In this case, we're going to assume that they'll receive about 85% of the maximum given their employment history and their target retirement age of 60. We also have old age security settings, so we'll leave that as a start age of 65 with an assumed benefit of 100%. Going over to Hannah, I'll adjust the CPPs to 65 with 85% of the maximum. And just like that, in about 10 minutes, we're done with the scenario setup inputs for Hannah and Ruben. Now you will see there are other pages available for us to use as needed. So if they had insurance policies that we wanted to model and discuss, we could enter those here. If they had an RESP still for their children, we could enter that here. We can customize additional settings. For instance, I could enable a dedicated module for charitable donations, which allow us to do cash, in-kind, or insurance-based donations. So we're going to turn that on in this case to show how that can be used for tax planning purposes. And then we can enter in corporations if needed. But for now, we're done with the scenario setup and we're ready to proceed to the planning pages, where all of the information that we've entered so far will come together to show us Hannah and Ruben's life on one page. Now, as the planning page loads, I just want to note that this page can seem overwhelming the first time that you see it, but once you know what you're looking at, it's an incredibly intuitive and very powerful section of the software. On the left, we have the year and our client's age. Then Snap has calculated the discretionary cash flow that they have available based off of everything entered in the plan so far. So I mentioned earlier that Snap can help us calculate the client's budget. It does that by simply taking all of their incomes, subtracting off all of the expenses entered in the plan, and then assuming that the remainder is available for either savings or spending purposes. So this is taking $250,000 of employment income, subtracting off their tax, EI, and CPP deductions, subtracting off the personal contributions to the RSP, and then their mortgage payments. And that leaves them with $150,000 left over that they can either allocate for additional savings or use for spending purposes. In order to enter their ongoing savings, we go to their individual planning pages. So from the top left, you'll see we can look at the combined household or either of their individual planning pages. We'll start with Hannah, and I'm going to scroll to the right where I can see key information like her taxable income, CPP and EI deductions, taxes payable, marginal and effective tax rates, and then all of the information about her various accounts. So we have her joint savings, non-reg, TFSA, and RSP, and we can enter in contributions, withdrawals, or adjust the rate of return in any year of the plan. So any blue or purple value that you see on this page is fully customizable on a one-off basis or for any period of the plan. I'm going to start by entering in maximum contributions to her TFSA. And one easy way to do that is to enter in a value that we know is higher than all future expected TFSA limits. I'm also going to enter in her RSP contributions, which is $20,000 a year, and copy that down to retirement. So now you'll see we've made these changes, but Snap has not yet updated all of its calculations. So rather than constantly refreshing the page on you as you're working, Snap will wait for you to confirm that you're done. You click on the orange run button, it will turn green, and that will update all of the numbers throughout the plan. And that way we know that our changes have been applied and that the results have been updated. And what we can see now is on the TFSA, our previous request of 15,000 has been replaced with the expected maximum each year. So Snap has guardrails in place to prevent you from accidentally over-contributing to registered accounts. So we have our TFSA, RSP contributions, and then the last thing that we'll enter on Hannah's planning page is she's currently making cash donations of $10,000 per year. So we'll enter that here, copy it down, and then Snap is automatically going to calculate the credits and figure out when and if we should be claiming those or carrying them forward or transferring them to the spouse. So all of that will get modeled and included in the plan. Now that we're done entering in Hannah's personal cash flow, we're going to go to Ruben and set up his contributions. And again, we'll scroll to the right to the financial assets. We'll enter in 15,000 to the TFSA, copy that down, enter in 10,000 a year to the RSP, and then we'll click the orange run button in order to recalculate everything. As we scroll back to the financial assets, once again, we'll see that the TFSA contributions have been updated to the expected maximums. Our 10,000 a year to the personal RSP have been completed. And now we can go back to the combined planning page in order to see the result of our final adjustments. So now before they were spending 149,000 a year, that's been reduced to 111,000, which is now factoring in the additional savings that they're making. So this 111,000 is Snap's version of the client's annual budget. It's saying this is how much they have left over for spending on items outside of the projection. That continues until they retire at age 60, at which point our target spending goal of 108,000 has kicked in. That's being indexed for inflation. We also have the additional travel budget and then our renovation goal. And all of this is being funded through a combination of the client's pension, their government benefits once those start at age 65, and then SNAP is automatically withdrawing from the financial assets in a tax efficient manner in order to fund the shortfall to their spending needs. So SNAP is automatically figuring out how much to take out and where to take it from. And it continues to do that all the way until age 100. And we can see at that point, they're expected to have about 1.4 million remaining between their TFSA and their RSP. So based off of their current plan, they are on track for their target retirement goal in 5 years' time. And what we can do from here is see whether there are additional tax planning strategies that we could apply to help provide even more buffer and give them additional options for their retirement period. In addition to the planning page, we can also review this information in the form of charts. So if I click charts at the top, we have a few options available. Here we have the cash outflow chart, which shows where the money is going each year of the plan. The base expense is that annual budget on items outside of the projection. We have the itemized goals of additional travel and renovation. We can see their income taxes each year, the mortgage payments, contributions to their investment accounts, and then the charitable donations. We can also see where the money is coming from each year, whether it's employment income, pensions, government benefits, or a combination of withdrawals. And then we can see their expected net worth broken out by key categories. And all of these charts are fully interactive. So if you click on any of the legend items, you can remove them from the chart. So here we've just modified the view in order to provide a liquid net worth projection. And so we can make those changes. We can also highlight individual years in order to drill into specific numbers. Now that we're done with our first projection, I'm just going to go to our list of projections that we want to create today. So we have scenario one without tax planning strategies. That's the first thing that we want to show. So if I go back into the software, because I've created a default plan today, Snap is already applying various tax strategies to the projection for us. So if I go into Hannah's personal planning page, you'll see that Snap is already splitting 50% of the eligible pension income over to Ruben in order to equalize their taxable income and reduce the total taxes being paid in the household. So that's a built-in feature that Snap turns on by default that you can turn off and on in order to demonstrate the benefit of that strategy. In this case, I'm going to turn it off in order to create a kind of no tax planning example where we don't have any of the automated or the additional strategies that we're going to use today. So we've turned off pension income. Snap is also withdrawing from the various financial assets in a tax efficient manner in order to try and increase the longevity of the client's assets. I'm going to turn on the ability to customize the decumulation strategy that's used in the software. And then we're going to set it to a common strategy that clients will typically apply when they're not being advised on a more strategic basis. So a very common approach is people are worried about their taxes on their final estate if they were to pass away early. So they may decumulate registered money first and then move on to the non-reg and TFSA once the registered is fully depleted. So I'll set that as the assumed decumulation approach. And then we'll take a look at what happens with no tax planning being done. So if the client is relying fully on registered money, they're not splitting it to their spouse, what happens is we get these spikes in marginal tax rates. So you can see they're into the 40% during the early retirement period, mid 30s, and then it's not until the very end of the plan that they can take advantage of lower tax brackets. But they're front loading all of their taxes payable. They're also creating OAS clawback as a result of their high taxable income. So this is going to be our first scenario that we'll use for comparison and discussion purposes. I'm going to click on the title of the plan and call this Scenario 1 without tax planning strategies. Next, I'm going to click on the menu option at the top, and I'm going to copy the scenario so that we can turn back on the default SNAP strategies. And this again, coming back to our list of goals for today, is scenario 2. We're going to apply the default tax planning strategies, which are pension income splitting and decumulation strategy. So I'll update the title to scenario 2 with default tax planning strategies. I'll go back into Hannah's personal planning page. I'll turn back on the pension income splitting. And then I'm going to update the drawdown strategy from the RNT back to the default, which is non-registered, then TFSA, and then registered. So now that we've made those two changes, we've got our scenario 2 with the default strategies in place. And the final step is we're going to copy it one more time, and we're going to create our third scenario. This is where we're going to create custom strategies and model them in the software in order to show the value that we can offer our clients by continuing to work with them over time to implement various tax strategies. That's going to include a discussion about their pre-retirement contributions, so where their money is going between their TFSA and RSP. We'll talk about target annual taxable income in retirement, TFSA top-ups, tax loss harvesting, and in-kind charitable donations. So the first thing that we're going to do is we're going to come back into the plan and we're going to update the title. So we'll call this scenario 3 with additional tax planning strategies. And then I'll go to Hannah's personal planning page. And we'll see that during Hannah's next 5 years of work, she's paying about a 43% marginal tax rate. Once she retires, that drops to an average of about 20 to 29% per year. So there's an opportunity for her to continue making additional RSP contributions in order to get the differential in those marginal rates back as additional tax savings. Right now, she's choosing to max out her TFSA and then putting the remainder of her savings into RSP. We're just going to recommend that she reverse that. So we're going to max out the RSP at $25,000 a year, and then we'll reduce her TFSA to $4,000 a year in order to account for the $3,000 net difference in cash flow. So we're increasing RSP by $5,000. She's going to get 40% of that back in tax refund. So really, it's only costing her $3,000 of annual cash flow. So that's the first step that we're going to do. Next is we're going to talk about their annual taxable income in retirement. So you'll see that right now, SNAP is taking full advantage of their non-deductible tax credits in order to get as much registered money out of their accounts as possible in the early years while leaving them at a very low tax level. That's efficient in a lot of cases, but sometimes it can be efficient to take more taxable income at the start of the retirement period. So we'll test that strategy by going into their assets. And we're going to change the conversion age of their registered accounts so that we can start taking the annual minimum out of their RRIFs and start receiving the minimum income and then eventually the tax credit for the pension income once they turn 65. So now we'll go back to the planning pages and we can see that there's now a blending of registered withdrawals and non-registered withdrawals in order to reach the client's target spending. Next, we can look at TFSA top-up. So right now we have them contributing to their TFSA all the way until retirement. And then the assumption is that they stop making those contributions. If we go to Hannah for a moment, what we could do is we could shift her non-registered portfolio, which still has a balance of about 270,000. We can start moving that over into the TFSA by simply contributing 7,000 a year and then copying that down until age 70. So once we enter in the contribution, SNAP is automatically going to make those additional withdrawals for us. We don't have to enter in both. We would just enter in the contributions. And now SNAP is going to pull that extra money from the non-reg, and then we're depleting it around the same time that we stop making the TFSA contributions. In terms of tax loss harvesting, SNAP Projections has default and customizable settings related to non-registered portfolios. So the investment returns that are coming from the growth on the account are broken out between capital gains, Canadian dividends, foreign dividends, and unrealized or deferred capital gains. And those settings are all fully customizable here. So what we can do is we can reduce the portfolio turnover in the plan from the default of 5% down to 2% in order to show what would happen if we use tax loss harvesting to offset some of the capital gains that she would otherwise be realizing on an ongoing basis. So we've adjusted the tax assumptions in the plan, again, to be able to demonstrate the advantages there. And then the final thing that we can show is she's currently making all of her donations as cash. So she's liquidating investments and then donating cash to her various charities. An alternative is she could stop donating cash. So I could set that to 0 for a year, and then she could donate directly from her non-reg portfolio, a total of 10,000, and that's going to allow her to avoid the capital gains payable on the portfolio or the portion of the portfolio that she's donating. So now that we've added those 5 strategies to the plan, the next step is to compare the outcomes of the 3 scenarios to see whether these are advantageous for our client. So I can go up to the menu, click on Compare Scenario, and then select the 3 plans that we've created. And we have a few different ways that you can review the comparison. The first is in the form of a table. So here we have a bunch of customizable metrics. So we have our goal progress. This is an indication of how much of the client's target spending is being funded with liquid assets in the plan. So in our base scenario 1 without tax planning strategies, they were just on track for their goal at 105%. By turning on pension income splitting and the decumulation strategy that SNAP defaults to, we increase that to 112%. And then by adding in our 5 additional tax planning strategies like the TFSA top-up and adjustments to contributions, we further improved the case by another 2%. And we can see how that's happening in the plan. So for instance, moving from scenario 2 to 3, we reduced the personal taxes payable from about 1.6 million down to 1.3. This was things like taking some registered income early, changing the TFSA contributions in order to avoid non-reg growth, and then also being able to make in-kind charitable donations. In addition, on the final estate, we can see that we reduced the final taxes payable from 82,000 down to 53. So overall, we improved their final estate by about $1 million between the beginning case with no tax planning strategies to our final case. In addition to being able to compare plans at points in time, we can also compare them over the entire lifetime of the projections. And this allows us to see maybe one plan is better for one particular period, and then another plan becomes better if they live beyond a certain point. So in this case, we can see that the scenario 1 is actually quite efficient for about the first decade of retirement. So if the client were to pass away anywhere from age 61 to about age 75, they would have benefited from heavily or aggressively deregistering their RSP. But if they live any point beyond that, we can see that scenario 3, our optimal tax planning strategies, becomes much more efficient, especially towards the end of the plan. So here there's a difference of close to $1 million between what they would have had if they had deregistered early versus implementing the various strategies that we recommend. So based off of this, we can make a strong argument for why scenario 3 is optimal, and that's what we would use in order to continue on with our client engagement, and we would create a report for this scenario 3 and move forward with the steps related to any of the tax planning strategies that we've identified. So that's the final step for today. I'm in scenario 3. I'm going to use the tool to calculate a couple of recommendations. So what this does is it allows us to figure out what the client can do with their overfunded status. So right now they have 1.6 million expected to be left at the end of the plan. And we have some calculators that can help us determine, could they delay retirement or retire early? Could they adjust their spending throughout retirement in order to use up or address their surplus or shortfall? So SNAP will calculate and help us to provide some options. So in this case, they could retire as early as age 58 while still being on track for their 108 annual target spending. Alternatively, if they are comfortable continuing to work until 60, we can let them know what an upper bound would be on their annual spending if they wanted to work towards using up the remaining buffer. Now, they might be comfortable leaving that for their estate, or they might look to increase their spending by about 10,000 a year up to 118,000. So as the final step, we've done scenario setup, we've done planning pages, and now we're ready to create a custom client report. So we'll go into the client report section, click on Report Builder, and this is where we have full customization over what pages, charts, and commentary to include. You'll see that there's quite a few options available for you to select from. This just provides different views, so charts, tables, simple views, detailed views. It allows you to really tailor the report to your preferences, your client's preferences, and what the specific case requires in terms of how much detail is helpful. So from here, you can customize what to include. In this case, I'm going to show the snapshot only option, which is the simple 1 to 2 page executive summary. So I've clicked snapshots only. You'll see all of the other pages are grayed out for the time being. And we're just going to be focused on these summary pages that allow us to provide a really high-level, digestible takeaway for the client on what's happening within the plan. And you'll see that we have 10 summary tiles available to select from, and I'm going to pick 6 of them that are the most relevant for this particular case, and that's going to allow us to fit everything cleanly onto one single report page. So to do that, I'm just going to drag a few of the pages out. So I removed the assumption summary. I'm also going to remove the expense summary, the estate summary, and the recommendation summary. So I've just dragged those out of my list. Now I've got my desired 6 summaries in the order that I want. I can go to Report Editor and review each of those pages individually. So the goal summary. We have Hannah set to retire at age 60 in 2030, Ruben at age 60 in 2030 as well. We can see their average spending per year prior to retirement and then after retirement. And the thing that I want to emphasize here is these are all referencing specific variables within the plan. So they're not hard-coded numbers that you have to come in and customize later if you change things. As you update the plan, as you review it in future years, all of these details get updated in real time so that you can just come back in and create a new report for your client. We do have the option to add custom text as well. So we could enter in additional travel, starting at, and then we can say the retirement age in, and then their retirement year. So you also have access to use the variables in your messages to the client so that they get updated dynamically with the plan. We also have a goal status page, which shows that for 114% funded status, gives us the option of retiring a bit earlier or spending a bit more, or we could add another text, leaving a larger estate. We have the financial asset flows, which shows our recommended adjustment to how much they're putting into their RSPs versus the TFSAs. We can see their net worth statement, so non-reg, TFSA, registered, and then their home. We can see their net worth summary, so how much they have in financial assets, real assets, and debt. And then their retirement income summary, which shows where their money is coming from over time. And now if I click Report Preview, all 6 of those get included on a single page in a very nice, digestible takeaway for the client. So we have our goal summary, status, flows, net worth, net worth over time, and then retirement income. And we could generate the PDF and then download that. And of course, if you want to include more information, you would just go back into the report builder and then select what other pages, charts, and commentary you want to include. And then you can save your template report for all future client files so that you just create one single template and then it's always there when you start a new plan. So that's the three scenarios that we wanted to show today. We have had to move quickly through the software in order to cover this content. If you do want to revisit any simpler videos or webinars, you can either go to our YouTube channel, or once you sign up for your free trial, you would be able to go to the help section in the top right and click on Help Center. And then you can access all of our previous webinar recordings on various topics. You can also search for key terms. So if you want to model an inheritance, you can go to the article related to that. We do have a dedicated customer success team available the moment you sign up for your free trial, and you can give us a call, send us an email, and we can schedule one-on-one screen sharing as needed to make sure that you're comfortable using the software. With that, I'm going to pass it back over to Alex. We're going to go through a few next steps, and then we'll open it up for questions.
Fantastic, Steve. Thank you so much. We have covered a lot this hour, but we are here to address any and all questions you have in just a moment. So, you saw at the beginning that we do have a special offer for those of you here with us today. We are going to give a special gift to every single advisor who signs up for a free trial of the software today. Each one of you who starts before midnight Eastern Time today will receive an extended 1 hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do here one moment ago. The snapshot is very flexible, but it's most often being used in three different ways, according to our advisors. It can be used as a standalone client deliverable that essentially replaces the longer client report. It can be used as a 1 or 2 page quarterly or annual review, and it can be used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one-on-one to create your template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you'll see there are two plans for you to choose from as an independent advisor. The advisor business plan includes the corporate module. If anybody would like to see that here today, let me know and we will try to cover that in the Q&A. You can upgrade and downgrade anytime, so don't worry too much about which plan you select today. We can sort out what you need during your 2-week free trial. I've dropped the link in the chat, so you can go to the chat. You can click that free trial link and ensure you get to take advantage of today's special package. And I will send that out via email as well. For those of you here today already using Snap, thank you so much for being here today and for being part of our community. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of Snap, and the referring advisor, that's you, gets an entire free month of service when the person you sent our way becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There is no limit on how many times you can do this. We've created a new referrals page that you can access from within your SNAP account that makes it easy to take advantage of the SNAP referral program. You can just send that link out to your advisor, friends, and colleagues. So, with that, let's move on to your questions. So, we've got lots coming in here. Um, First question, Steve, and this one, I think we should have time to cover this. This one is a little bit in depth. But how could we use these projections to build a case or a need for critical illness insurance?
Great question. So in terms of the um, critical needs, what we would do is we can either use the needs analysis. So if you come into needs analysis at the top of the planning page and then go into the critical illness insurance, we could either use this new tool that was launched a couple months ago, and we have some dedicated webinars outlining how to take full advantage of it. But you would either be able to enter in here, the client's current income, how long they would want to replace that for if they were to experience a critical illness. So maybe they need 80% of their salary, and they would do that for 12 months. And we would want to cover the spouse for 6 months. Sorry, 80% for 6 months. And then maybe they have some other expected medical expenses and they want to remodel the home. Oops. So they need 40,000, and we can add as many, or we can add multiple custom liabilities, rename them. So you can either use the needs analysis in order to calculate the exact amount of coverage that you would recommend, and then we would offset that with any existing coverage that they have in place. So let's see. So we've created that. And then I would click summary at the top, and that's going to tell us how much critical illness insurance would be recommended. So we've got 152,000 required to replace their incomes. So that's 130 times 80% for 12 months for the client, 120 times 80 for their spouse, some additional expenses. And because they have none in place currently, we need about 200,000 of coverage. So that's one option, is the dedicated calculator. Another option is we can dynamically show what would happen to the plan if they were to have a critical illness. So if we go to Hannah's page for a moment, maybe she gets a critical illness at age 56 and she stops working for the next 2 years. So we would have 2 years of no salary. And as a result, she would need to withdraw from her accounts instead of contributing to them. So we could take 40,000 out of the TFSA and 30,000 out of the RSP. And then what we could do is we could compare that projection to their previous one, the base scenario where they were on track. So as I scroll to the bottom, you'll see they still have enough to meet their target spending, but now they have 600,000 in the final year rather than the 1.4 million that they had before. So if we were to compare just those two scenarios, the original to our critical illness case, we can show them how much even 2 years of lost income would have on their situation. So here we have our original case, and here we have with the disability applied. So they go from about 4.6 million final estate to 3.7. And so this can be a way to illustrate the need for coverage and then to quantify how much would be recommended. So either of those two approaches are available. And sorry, Alex, I just want to take a moment. I didn't mention earlier, but we've spent the last decade with Snap building features to allow you to model all sorts of different accounts, transactions, and situations. And today's demonstration showing tax planning strategies is what we're working on next in terms of automating. So a lot of the steps that you saw us do today manually are currently being automated within the software. So being able to top up TFSAs and set target taxable incomes, that's one of our major focuses at the moment, is to make that planning experience as quick and simple as possible so that you can, spend as much time focused on the client engagement and recommendations and less time worrying about the software itself. So that's what we're currently working on.
Fantastic, Steve. Great point. Thank you for mentioning that. Okay, so that covers the insurance, and then we should also just point out we've got the same capabilities for life insurance, critical illness insurance, and disability insurance, all right there under the needs analysis. So fairly new feature. Advisors are really getting a ton of value out of this. So next question, we would like to see the corporate module, please. Just show us briefly what we can do with that.
Okay, so if either client in this case had a corporation, we can click Add Corporation at the top. We start by setting up the corporation settings, so where it's incorporated, whether it has the small business deduction eligibility, whether there are any notional account balances, so RDTOH, capital dividend, general rate income pool. Now, you can leave all of these 0, and that's just going to create a more conservative projection because you're not going to be showing the tax efficiencies available through those notional accounts. And then if and when the client or their accountant provides that information, you can update it here. Importantly, Snap will calculate all of this within the plan going forward. These are only the values for the starting year. So Snap will take care of everything going forward in the projection. We can also customize the ownership and how and when and what tax assumptions you want to use for the disposition of the corporation, either in a future year or post-mortem. Once we've set up our corporate settings, we would have a very similar scenario setup experience that we had on the personal side. So we could add in things like investments, say they have 50 or 500,000 at the moment. We could add real assets if they had a property, add in debts, corporate insurance, and customize additional settings. And then just like on the personal side, we would have planning pages available. So we could model the operating income if they have active income. We could pay out salaries from here, which would then be reflected on the personal side. And if we don't have any salaries or expenses, what will happen is Snap will automatically take the net of tax proceeds and it will put it into the holding account balance. So Snap is modeling both the operating business and holding company within the same corporate entity in the software, and it's realizing all of the interrelated tax considerations. Then in retirement, we would be able to pay out dividends. So let's say they want to distribute 100,000 of non-eligible dividends each year in retirement. Snap would automatically make the withdrawals out of the corporate investment account, and then that non-eligible dividend would be included on the personal side for spending. So the corporate module is quite robust and fully integrated into the personal side.
Perfect, Steve. Thank you. Last question we will try to squeeze in here. What do we have for stress testing analysis?
Yeah, so right now, the way that we've created our base scenario, you can see that our rate of return assumptions are static each year. So we have 4.1% for the non-reg, TFSA, and RSP. We have 1% for the joint savings, and that's all based off of the rates of return assumption and the asset allocation. Sometimes you may want to use randomized or historical variable returns in order to have a conversation with a client about volatility, market risk, sequence of return risk, and how lower than expected returns would impact their outcome. So if you go to stress testing, which is an optional add-on, you would click on either historical or randomized. I'll use randomized in this case. And you'll see that Snap creates a series of random annual return assumptions for cash, fixed income, equity, and inflation. And it allows you to select a desired sequence to then apply to your plan. So you could pick the worst case scenario, a middle of the line case, best case, or as I typically use, the 20th worst case. So about 80% of the time, they should be better off than what we're modeling here. So I would pick that period and then apply it to the projection and see how that impacts their outcome. So Snap will override the annual return assumption on the planning page. And so here we can see our 15% return, and then we get a bear market here, we get another drop close to the start of retirement. And then as we continue all the way down in the plan, we can see that they are still fine in this case, just because of the way that the particular rate sequence has worked. So again, it helps us to have different conversations about volatility, sequence of return, lower than expected returns, and the idea of income guardrails and how, over time we'll be able to adjust the plan and move their spending up and down as we learn more about their final account balances.
Fantastic, Steve. Thank you. Well, everyone, we are at time. So we're going to have to call it there. I see I still have a ton of questions we haven't answered. I will follow up with each and every one of you via email. You will get your questions addressed within the next day or so. Everyone who is here live will receive an email with the video recording tomorrow, and that will include a form to fill out to request your CE credit. And I think that's it. So thank you so much for being here live with us today. I hope this has been a valuable session for all of you. Enjoy the rest of your day, and I'm looking forward to continuing the conversation. Bye for now.